Bank runs are about to begin as consumers look to pull deposits. I'm your host, Steven Van Metre, and thanks for joining me today. And with inflation heading higher and rates going up to back it, consumers are looking to do something they haven't done in a long time, and that's pull money from the banks. Let's head over to the Wall Street Journal, who headlines that bank deposits could drop for the first time since World War II, as analysts have been slashing expectations for bank deposits in recent weeks as Fed rate increases ripple through the industry. And U.S. banks have had a streak of increasing deposits as a group every year since at least World War II. This year could break it. The swift change in expectations is an important indication of how the Federal Reserve's hiking cycle is landing on the financial economy. Forecasts from federal officials and economists now show for a sharp increase in Fed's core interest rates to combat inflation. That will ripple through the banking industry in myriad, somewhat unpredictable ways. How consumers and businesses handle their stored up cash will be among the most closely watched results of the Fed actions. And in periods of rising rates, what happens is consumers demand a higher interest rate for their money. And so when the banks refuse to pay it, well, consumers are going to start looking elsewhere. That could have some interesting ramifications for the banking industry. Let's continue on, because the decline isn't going to hurt the banks. The flood of deposits has become a matter of fact a headache, as it had a big banks nearing regulatory limits on their capital. And banks have already been pushing away many depositors because they weren't able to put the money to work as loans. And the industry has an $8.5 trillion more in deposits than loans, according to Barclays analysts. And they're right. While loan demand is expected to increase and the banks need deposits to fund the lending, they have more than enough on the books. And here you can see from the Federal Reserve database, we see deposits in blue and loans and leases in red. And there is indeed an $8.5 trillion gap between the two. And I want you to note that this gap really started, and yes, there was a bit of one prior to that, but notably it started when we did this thing called quantitative easing 1. And then it got worse as we did 2 and 3. And I want you to understand that these QE programs are monetary cancer to the financial system. And you can see right now from a bank's perspective, they got a lot of deposits that they can't put to work and perhaps might be happy to see you take your business elsewhere. Let's continue on. Because banks were supposed to benefit from a slow and methodical increase in interest rates. And that would allow them to charge more on loans and keep near zero the amount they pay to depositors. And banks, after all, won't pay more for funding they don't need. That combination would boost what had been record low profit margins. And that's kind of the idea of, you wonder, why does the Fed raise rates very slowly? Why does the Fed want inflation to go up slowly? Because when you go to the pump and see a couple extra pennies, it's not a big deal. Or you go to a store and it's an extra buck or two here from a retailer or a wholesaler or even a manufacturer. We get used to it over time. But you have big leaps in prices and people have a shock reaction to it. And so the Fed, in the same notion, wants interest rates to go up slowly because the banks could slowly raise rates and they could build off of that. But when rates jump, what have we seen? Well, borrowers say, not interested. Let's continue on, because the most likely beneficiary of money market funds, short-term investments that often capture overflowing deposits from banks. And here you can see from the overnight reverse repurchase agreements from the Federal Reserve database, there's already more than $1.7 trillion in money market funds being parked at the Fed now. And the reason is we don't have enough collateral to back all of that money. And that's a problem. And we'll get to that in a second about what's actually going to happen here, what I think is going to happen. Historically, consumers and businesses have been slow to move the most deposits out of banks to chase interest rates, but the sheer volume of excess cash floating around could change that behavior, especially if the Fed moves rates faster than it usually does. The Fed is now expected to boost interest rates by 0.5 percentage point at its next meeting instead of the typical 0.25 percentage point increase. And the money market funds started parking the overflow of the newer program of the Federal Reserve, as we just talked about, and that is the overnight reverse repo program. It's holding over $1.7 trillion. Because it is new and suddenly so big, bankers and analysts have been unsure what will happen to those funds as the Fed started moving rates. For months, many of them viewed them as excess funds that would follow the general idea of last in, first out. Now, some analysts are reversing that theory and expect money market funds to march their rates higher along with the Fed, which would keep them more attractive than bank deposits. So what we are in a situation here is when you understand that there's $8.5 trillion more in deposits than there is loans at the banking system, the banks actually would like to see that money leave. They don't need it. And so we get this notion that, okay, the Fed's going to potentially start unwinding their balance sheet this summer, and that's going to have major problems. Actually, it's not, in a sense, if you are a major bank, because that means those deposits that you're being forced to keep there due to the Fed, you now have the option to release them. And where is that money likely to go? And when you think about it from a consumer perspective, you go into the bank and you complain, hey, I'm not making much money here. And they say, oh, well, Mr. and Mrs. Customer, I've got good news for you. Check out our new money market fund. And it's got a much higher yield than you're used to paying now. Let's move all of your money over there. And of course, people will do that. And what does this mean? From a balance sheet runoff perspective is, yes, the Fed will sell off treasuries, and they predominantly want to sell off mortgage-backed securities. Now, those mortgage-backed securities are going to have to be absorbed by the market. And what kind of premium the market's going to want? Well, it means they're going to want higher yields. But what about these money market mutual funds? What are they supposed to be backed by when they're not being backed by the Fed? Well, they're backed by short-term treasury bills, everything from 12 months and under. So all the quantitative tightening that's going to happen, all the balance sheet runoff, the market's going to have to absorb the mortgage-backed securities, while everything else is going to get shoved into short-term treasuries. And so you start to think of what would happen if a flood of money entered the front end of the curve. Is it going to drive short-term rates higher or lower? Well, if you pick lower, you got it right. And that's the concern of what's going to happen. And we'll see that the short-term rates will fall, and of course that will cause the yield curve to steepen and bring long rates right down with it. But let's continue on, because now some analysts are reversing that theory, and they expect money market funds to march the rates higher along with the Fed, which would keep them more attractive than bank deposits. And so the question is, what is the Fed paying? Well, here we see from the Federal Reserve website, conduct overnight repurchase agreement operations at an offering rate of 0.3%. So that's what they're paying on those deposits. And here are T-bill rates as of yesterday. You see 1, 2, 3, 6, and 1 year rates. And these are what money market funds buy, are T-bills. Now you're saying, are you sure they don't buy mortgages? 100% sure they don't buy mortgages. They redid the money market money market fund act, or there's some sort of law they did. I forget the exact name of it. But what it essentially said is you can buy anything that meets these requirements. It just so happens there's only one thing that meets those requirements, and that's T-bills. And they've got to be 12 months or less, because think about it, when you want your money market funds, it's got to be liquid. It's got to be liquid now. And so look at these rates. You could see they're anywhere from 22 basis points all the way up to 185 basis points, indicating that money market funds could actually handle higher rates here and meeting the demand for all this flood of money. The problem is there's a collateral shortage, and that means the U.S. Treasury is going to have to issue more T-bills and start issuing less notes and bonds, notably, which we've had a lot of circumstantial evidence hinting by the Fed that that's exactly what is coming. But what else happened today is in the inflation story. But before we get to that, if you're concerned what a balance sheet runoff means to your portfolio, which usually markets crash, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up there in the corner in the description below. You'll be glad you did. Now let's pick up this inflation story, because extraordinary U.S. consumer price soars at the fastest in over 40 years, according to Zero Hedge. And really, we see this month-over-month number of 1.2% is huge. It's a big number, and that brings the CPI to 8.5%. And of course, we haven't seen numbers like this since the 1970s and 1980s. And remember, the cure for high inflation and high prices is, right, high inflation and high prices brings it right back down when consumers reject it. But let's dig into the details, because there's something very interesting here, and that is in the core CPI, which printed a mere 0.3% month over month. In fact, had some little bit of negative numbers here, and the core is far less volatile. And what it means is if the core starts to cool off and head lower, which we expected, because remember we talked about goods inflation and all these imports coming in that are going to drive prices down. Well, what does that mean the headline number is being driven by? Well, it's being driven by food and energy. Now let's go back and look. We see food running up 1% per year, or 1% over last month, which is a big number. Nowhere near as big as energy, up 11% over the prior month. Now what happens now is when energy prices cool off, and we're already seeing crude oil come down, and you know that President Biden is going to release the strategic petroleum reserves, and we've looked at other data. We'll look at that data tomorrow with the inventory levels. We already know the probabilities that crude oil prices are coming down, and that means gas prices coming down, and that means inflation also coming down. Let's continue on, because a big issue with this story is, well, your wages aren't keeping up with inflation. In U.S. real being inflation adjusted, average hourly earnings adjusted for inflation down minus 2.7% year over year. And as we talked about in yesterday's show, it tells us one thing very clear, that consumers are not keeping up with inflation. That means less spending ultimately leads to less inflation. And then on top of that, the banks could be flooding the money market funds with all these deposits as customers look to get a higher rate. Well, that would drive the yield curve higher, short-term rates down, and of course, now you've got all the markings you need for a recession. I'm Steve Van Metre. Thanks for being fans. Thanks for watching. Bye now.